volatile markets, losses and gains are not created equal. The smaller the loss, the easier it is to get the gain back, obviously. But if you have a 10% loss, it takes you 11% to get it back.
That's right.
If you lose going higher, if you lose a third of your portfolio, it takes a 50% return to get back. If you lose half the portfolio, you have to double it to get back to even. So that's why it's so important to have your bucket approach, have your plan, and stay committed to a plan. Give your portfolio time to come back, and the bigger the losses, the longer it takes.
Well, I think that also comes down to where you can look at tilting, right? So let's say you have your initial stance, let's say that's a moderate stance. And so you may have the ability too, where it's like, hey, if equities are going to be doing well, because equities have over time outperformed the bond market, but you tilt back and forth, right? So you have your original stance, and as equities in the stock market's doing well, you can tilt more towards equities. But when it's not doing so well, get back to your original stance, and if it's getting worse, tilt maybe moderately conservative. But you're kind of moving back and forth in terms of an investment plan.
Yeah, there can be times where equities are more appealing, or stocks may make more sense. But going back to the time in the market versus timing the market, it's really hard to have perfect timing or know when to be in or know when to be all in, all out. And so
Right.
It's important to have an allocation you feel good with. If you want to let it run a little bit, you can do that. If it's something it's run too much, that's where we talk about rebalancing. It's
right.
really important. You can take some of the winners, pare it back, get you back to where your desired allocation was. But just really a portfolio management process.
Yeah, right. I mean, I'm glad you mentioned that, because rebalancing is important, because you're going to have some, especially when you have some investments or securities that are doing well, it's overweighting your ship, if you would. So you need to get back into balance. And I believe that's important to do. The other thing too, as we've talked about rebalancing and then the bucket approach, is also the withdrawal rate. I want to touch on this, Tommy, because in terms of, you mentioned this plenty of times during this episode, timing of losses and also changing the withdrawal rate. We have some examples. I want to go through those.
Two investors, $1 million each, looking at a 5% withdrawal rate increase for inflation. But the first investor retired at a poor time. Market experienced a 15% decline during the first 2 years. Second investor had a good 9-year run in the market prior to 15% declines in years 10 and 11. And you can see from the example just how much the timing of losses can impact portfolios, especially when you're looking at withdrawals from those portfolios.
Oh, for sure. I mean, because like we talked about, a lot of retirees are pulling from their portfolio. That's why we always monitor what is your withdrawal rate, meaning what are you pulling out of the account? Because again, we don't want to see your retirement doing this over the years. We want you to be able to enjoy retirement and also seeing your account move forward, always pushing that needle forward. That's a big one. Now let's move on to changing your withdrawal rate. So let's use that example.
These two individuals both had $1 million, both lost 15% in the first 2 years. Mm-hmm. And you can see the impact of changing that withdrawal rate. So portfolios after the first 2 years growing at 6% a year, in the first person was able to reduce the withdrawal rate to 2%. Second person needed that 4% withdrawal rate. And you can see the difference. It took 11 and a half years for investor one to get back to even.
Look at that. Yep.
Investor two, it took them 28 years.
That's unbelievable.
And so we've talked about the bucket approach, but if you are able to minimize some of those withdrawals in the event of a decline, this example kind of highlights just the impact of withdrawal rates on portfolios coupled with losses.
That's such a great example there, because again, that withdrawal rate's important because people are living longer, Tommy, and one of the number one fears of retirees is running out of money. Thanks for watching Retire Vivid. Want to see more? Like and subscribe to our channel to stay up to date with exclusive Vivid content. Plus, be sure to watch our show Retire Vivid every weekend. We're here to help you get retirement ready.